Hello everyone. I welcome you all to my online presentation on the topic concerning to COVID-19. Friends, as you all know that COVID-19 is disrupting our life in its entirety, including the social, political, economic and academic aspects. Among them, the pinch of economic hardships of COVID 19 is already being experienced by each one of us during these days of lockdown and seal down periods. This experience naturally raises a couple of questions. Question number one: how is our national economy is being affected by COVID 19? Question number two: how are the various constituents of our economy are being influenced by COVID-19? A number of similar questions arise in our minds, isn't it? Among the various constructs of an economy, markets are of paramount significance. Among these markets, financial markets in particular are indispensable for an efficient functioning of the economy as a whole. Friends, financial markets in simple terms means a market where we borrow money or lend money depending upon our requirements. Each one of us have been a part of this process in our day-to-day lives. In this background, friends, I wish to share with you my thoughts on the way COVID-19 is impacting on the capital markets. Friends, capital market means a market for borrowing money or lending money for long-term purposes. Among capital markets, I am focusing today on stock markets in particular in my presentation. I am sure you have all heard of the Bombay Stock Exchange. Yes, that is a stock market. My presentation will revolve around the affairs of Bombay Stock Exchange. Hence, the title of my presentation is Impact of COVID-19 on Capital Markets, a perspective of stock markets. Friends, I believe you all enjoy this presentation. Now, let us move on to the next slide. This slide contains a list of issues that we will be discussing in this presentation. It is an empirical study which obviously has to pass through an established framework of research. In the first instance, under context setting, I wish to present briefly the background of pandemics, followed by the motivation for undertaking this study. For any study of this kind, we need to raise a set of questions such as: what is the focus of the study? What is the scope of the study? What objectives have been set as a part of inquiry? And what methodology is adopted in fulfilling these objectives? Once we answer these questions, we will be discussing on the various aspects of impact of COVID-19 on capital markets, including the underlying issues with their appropriate depths and dimensions. For this purpose, a flowchart is prepared portraying the framework of analysis and discussion. Finally, we will be drawing meaningful conclusions based on our analysis and discussion with appropriate data support. Friends, let us move on to the next slides pertaining to context setting. Under context setting, I wish to make a mention of 2 points. One, the footprints of the earlier pandemics. Two, COVID-19, its roots and repercussions. Please have a look at this table on the footprints of pandemics. It is evident from this table that the world has seen as many as 4 pandemics during the last 100 years. Flu being the major pandemic, has stayed for a year or two, causing the death toll ranging between 1 to 50 millions. Interestingly, HIV/AIDS has stayed for a longer time, that is, up to 7 years, causing 36 million human fatality. Now, it is the turn of COVID 19 since December 31st, 2019, when China reported to the World Health Organization, that is WHO, about the patients in Wuhan having mysterious pneumonia. Since then, COVID 19 is raising its ugly head world over, affecting about 4.30 million people as on May 13, 2020. It is a new virus to which no one has immunity. Let us now turn to the next slide on statistics about COVID 19 in Indian context. India reports its first case on COVID 19 on 30th January 2020 and the first confirmed death due to COVID on 15th March 2020. As on 13th May 2020, India has the 8th highest active cases of coronavirus in the world. Among 78,000 cases in India, 28,000 have been decided, where there are 9% deaths and 91% recoveries. The remaining are active cases undergoing treatment. Friends, to reiterate, COVID 19 has impacted on every walk of life, and our focus is on its impact on capital markets. The motivation for this study is explained through next slides. Dear friends, the motivation for this study emanates from the way the COVID 19 handling strategies are initiated and the impact these strategies bear upon the economy and capital markets. As I already mentioned, there is no vaccine or cure for COVID 19. Therefore, the Government of India was very much concerned about the lives of people living in India and abroad. In response to the panic expressed by the Indians residing abroad, the government arranged for airlifting them from COVID 19 sensitive countries such as China, Italy, Iran, and Japan. In addition, the government initiated for screening the international passengers at the airports. Later, it suspended visas and international travels as well. Within the nation, the social distancing is the only way out for preventing the spread of this disease. Therefore, the government took a bold decision of national lockdown in three successive phases from 24th March to 17th May 2020, and the fourth phase of lockdown is in the offing. Friends, now let us move on to the next slide to know more about what lockdown includes and implies. From the list, it's very clear that the economic costs of lockdown are too heavy to bear because the borders are sealed, movements of people are restricted, all essential activities are shut, railway, intercity, bus services are suspended, all kinds of gatherings are suspended, schools, colleges, malls, cinema halls are closed except the essential supplies, groceries, pharmaceuticals, and banks. Friends, it's now very evident that due to the lockdown, the wheels of the economy have come to a grinding halt, entailing a huge spending without much revenues on the part of the government. In addition, the future uncertainty has also escalated the economic tension. This lockdown led economic scenario has certain apprehensions, such as, can the corporate sector get funds for long term purposes in future? What will be the stability in the corporate earnings? How attractive would be the return on equity? Could the shareholders' wealth be intact? What will be the investors' confidence level about the stock markets? And finally, what will be the stability in equity markets in the near future? Friends, these questions are genuinely bothering. They have in fact triggered for embarking a study of this kind. I am confident that we are now well set to know more about the focus, scope, objectives, and methodology of the study. To begin with, let us take up the focus of the study for a brief discussion. This study has a short-term view of the stock market movements owing to COVID-19. The reason for this short time horizon is self-explanatory. As I mentioned earlier, that it is only with the reported cases of patients' mysterious pneumonia in Wuhan, China on 31st December 2019 that the topic of COVID-19 and its varied ramifications came for a serious discussion gradually. Viewed from this angle, it may look to be too early to undertake an inquiry on stock market movements as the intended phenomenon is still evolving. Friends, as far as the inquiry on impact of COVID-19 on stock market movements is concerned, we have examined a period of about 4.5 months from 1st January to 13th May 2020. Whereas for projecting the moments in the stock market, we have considered a period of approximately 7.5 months, that is from mid of May to end of December 2020. Secondly, let us now glance on the scope of the study. Friends, we need to use a stock market index that provides a means for measuring the overall trends in the share prices in the stock market. It is like an instrument that tracks the overall behavior of the stock market. Since we have selected Bombay Stock Exchange for our analysis, we are using BSE SENSEX among others. SENSEX is composed of 30 scripts selected on the basis of their size and daily trading volumes. Scripts are given weightage on the basis of their market capitalization. Thirdly, let us look at the statement of the objectives. Friends, this study has set four clearly defined objectives, and the statement of the objectives are as follows. 1. Examine the stock market movements with reference to BSE in the COVID era. 2. Evaluate the impact of COVID-19 on capital market movements in India. 3. Project the future directions in the stock market with reference to Sensex. And 4. Assess the prospects of market recovery in the near future. Finally, let us have a quick look at the methodology of the study. Friends, this is an exploratory study as the phenomenon under scrutiny is at its nascent stage and is yet in an evolving mode. It is based on secondary data drawn from various sources. This study adopts a simple descriptive approach in its data analysis and presentation. We have used MS Excel tool for generating the required tables and graphs for our analysis. Against this background, now let us know about the design of the presentation. Please look at this flow chart on design of presentation. As you would see, there are three key topics, namely conceptual note, analysis and discussion, and the way forward, which make up this design. Firstly, the conceptual note dwells on three concepts, the understanding of which help us appreciate analysis and discussion. The second and the most important one is the analysis and discussion section, which is structured into four topics and each topic representing each objective of the study. As you have already seen, there are four objectives for the study, and therefore now you would see four topics under analysis and discussion. Wherever possible, the discussion under each objective is undertaken at greater depths. For instance, in case of Objective 1 on COVID 19 and stock market movements, the discussion further boils down to pre lockdown and post lockdown periods. The last component of design of presentation is on the way forward, which ponders over the strategies to be adopted for taking the economy and the capital markets in the right direction during these turbulent times. Friends, with this background, let us now move on to the next slide on conceptual note. Let us have a look at this slide, which depicts the structure of financial markets. Please recall the general meaning of financial markets and capital markets, which I have narrated in my opening remarks. In this flowchart, you please look at the capital markets. And in the capital markets, could you trace the secondary market or stock exchange? Stock market or stock exchange is on the bottom right box. Please note, in this box sits our Bombay Stock Exchange, whose stock behavior we are going to examine. Why did we choose Bombay Stock Exchange, and how could the stock movements be measured through SENSEX are narrated in the next slide. Bombay Stock Exchange, established in 1875, is the oldest stock market with 145 years of experience in stock market operations. Bombay Stock Exchange is strong enough to set the tone and tenor to the entire stock market in the country. SENSEX provides a means for measuring the overall trends in the stock market. It is regarded as the pulse of the stock market. SENSEX also indicates the booms and busts of the stock market. Friends, with this background, we are well set to get into the analysis and discussion. And now let us look on to very impressive slides on data analysis. In this graph on COVID and stock market movements, you would see the dates or months from January to May on x-axis and SENSEX values on y-axis. From this graph, you get to know how the stock market movements have fared themselves over these 4.5 months. Please notice the colors of SENSEX line. It is shown in two colors, one the blue, the second one the black. The blue line pertains to the movements in SENSEX during the pre-lockdown period, and black line indicates the movements in SENSEX during the lockdown period. Interestingly, the Janata curfew connects these two dots. Now, what is the takeaway from this graph? One of the striking aspects of the stock market movements is that there has been continuously falling trend from January 1 to March 23rd. It has reached a rock bottom point on March 23rd. Similarly, the stock market movements during the lockdown period is trailing down with no immediate signs of recovery. Now, we need to get into detailed analysis in the stock market downfall with the underlying causes. Hence, let us move on to the next slide. Please see this slide on analysis of market downfall. This analysis is carried in two stages. One, analysis of downfall during pre-lockdown period. Two, analysis of downfall during the lockdown period. Let us take up the analysis during the pre-lockdown period and hence the next slide. Please see the SENSEX curve and notice the trends in the stock market movements month-wise. Now see the trend in the downfall for the month of January. The trend in the stock market is downward but not steep. It could be inferred that stock market decline is setting in January itself. There are specific reasons for this, such as mysterious pneumonia cases in China, declaration of health emergency by WHO, emerging COVID death cases in India, etc. Now look at the market movements in February. During February, the downfall continues and becomes deeper at the end of February, probably due to huge COVID cases in China, COVID-19 death cases beginning in France, high-level alerts made in South Korea, and World Health Organizations announcing COVID-19 risk of spread as very high. Let us make a similar observation for March up to 23rd. The stock market has very heavily come down in March. Please note, this is the fastest crashes in the history of Indian stock market, even worse than 2008 crash due to global financial meltdown. Now, what are the drivers for this phenomenon? World Health Organization declaring COVID-19 outbreak as a pandemic, rising COVID casualties in India, COVID casualties crossing 2 lakhs at the global level, etc. could be the prominent drivers for this massive downfall in the stock market. We can also measure the actual downfall in the stock market during the pre-lockdown period. Hence, the next slide. Please see this slide on downfall in BSE. On the left side, there is a table and on the right side, there is a graph. The table contains the details of fall in SENSEX in actual points and percentages. See the quantum of downfall in numbers on different points of time from this table. You can find in this graph the actual SENSEX points and also a linear line for the same. It is evident that the gaps in the stock markets have increased and have consistently widened from January to 23rd March. Now let us make a similar analysis of market downfall during the lockdown periods. Hence, let us move on to the next slides. It is evident that there was a deep hit in the market in the early phase of the lockdown period. This could be inferred as COVID-19 pandemic-induced market instability. Lockdowns and the economic stimulus could enthuse the market during the fag end of March, which was immediately followed by a downward trend till the first half of the first week of April 2020. The COVID cases surpassing 1 million globally and the economic cost of COVID-19 are the causal factors. Thereafter, the market has maintained a gradually increasing phase with a few downs in the first week of May. Now let us measure the downfall in the stock market movements. Therefore, let us go to the next slide. Please see the downfall in the BSE. The SENSEX values and their visuals for the lockdown period till May 14th are presented here. You could find that the stock market was relatively positive as compared to March 23rd in the first week of the lockdown. The causal factors include keeping open the essential services and pharma and life science sectors doing well. We will in fact discuss in detail about the sectoral impacts of COVID-19 later in the discussion. The dip in the first week of May could be due to the stock market's disappointment on account of extension of lockdown. Interestingly, it picked up towards the end of lockdown. It is found that just a few days before the end of the every lockdown, that is before April 14th, before 17th May, stock market responded positively. Friends, the next major issue before us is to examine the impact of COVID-19 on capital markets in terms of capital erosion, sectoral impacts, and other antecedent matters. Let us move to the next slides. As you would see from the table, there has been an erosion in the wealth of the shareholders at different points of time during the pre lockdown period. In a nutshell, the Sensex has given up almost 12,700 points during January March 2020 and thereby causing a 31% drop amounting to rupees 42.60 lakh crores of wealth erosion of the shareholders. Friends, on the right side of the table, you will find the list of major losers in the pre lockdown phase. In the banking and financial services sector, the Indus Bank, ICICI, HDFC, Axis Bank, Kotak Bank, and Bajaj Finance are the major losers. In IT and telecom sector, Tech Mahindra, Infosys, TCS, Intratel, and Bharti International. In manufacturing sector, ITC, L&T, Reliance India Limited, Tata Steel, Bajaj Auto, Titan, Sri Cement, and ITG. And finally, in the energy sector, Power Grid, NTPC, ONGC, and BCL. So these are all the major losers in the pre lockdown period. Now, let us look at the state of affairs of investors' wealth and the major losers in the lockdown period. The wealth erosion in the lockdown period is far lesser than the pre lockdown period. In terms of sectors, we don't find energy, oil, and natural gas in the lockdown period as a losers. However, other sectors continue. In terms of sector wise losers, we find that the number of players has come down in all the sectors except banking and financial services. With this background, let us try to see a bigger picture of the ways and means through which the lockdown is going to impact on corporate sector and capital markets. This slide on impact of lockdown on corporate sector and capital markets opens up three different but yet interconnected approaches. One, lockdown impact on corporate valuation. Two, impact of corporate valuation on GDP. Three, impact of GDP on capital markets. The connecting links between the impact of lockdown on corporate valuation and in turn on GDP are self-explanatory. Please see the first blue boxes one by one and then see the points below the corporate valuation till you reach the point fall in GDP. This fall in GDP is deeply impacting on the capital markets in particular. It is damn sure that the GDP of our country is going to come down because of COVID-19. This decline in GDP has a direct impact on capital markets. There would be a major cause of concern because it badly affects feel good factor about the Indian economy, investors' confidence in capital markets, stability in financial markets, and investment in corporate sector as a whole. I am going to share with you later the data on the different estimates about the likely decline in the GDP, and that is going to help us understand the kind of ripples it is going to create on the stability of the capital markets in our country. Friends, so far we have discussed about how is the stock market in pre-lockdown and post-lockdown periods and its impact on different facets of the capital markets. We have now a major question, and that question is, how would stock market look like in the near future? Let us therefore take up a discussion on projection of stock market movements in the near future. Please look at this slide. It portrays the forecasted SENSEX for the forthcoming period from the mid of May to end of December 2020. There appears a question: how are these SENSEX values forecasted? Stock market forecasting is challenging as the SENSEX values are dependent on demand supply conditions of stocks. In addition, the moments are linked to macroeconomic determinants as well as policy initiatives. The equity analysts, in particular, use various methods and indicators to predict market movements. In this graph, we have drawn forecast values of SENSEX drawn from the Financial Forecast Center records. This center specializes in prediction of many economic and financial indicators, including stock market forecasts. It is evident that FFC, that is the Financial Forecast Center, has forecasted SENSEX values ranging from 33,030 for May to 35,730 for December 2020. SENSEX is rising except a drop in June 2020. FFC appears to have an optimistic outlook for stock market despite COVID-19. We can enhance the utility of forecast values for meaningful conclusions about capital markets in two ways. One, inter-period comparison of stock market movements. Two, one-shot view of stock market movements. Let us now take up a discussion on inter-period comparison of stock market movements, including projections. Please see this graph containing SENSEX curves for 3 successive years, that is 2018, 2019 and 2020. It offers insights on how does the capital markets of 2020 in the COVID-19 era stand in comparison with 2018 and 2019 moments. Here are a few observations. One, year on year, capital markets open with an optimistic note in the beginning of the year. Stock market in 2020 in particular began the year with a very high optimistic note. 2. Between 2018 and 2019, the stock market in 2019 has performed better. However, both have maintained a steadily increasing phase except during August to September. 3. The performance of SENSEX during 2020 will be mostly poor compared to 2019, but eventually it might end like 2018 despite COVID-19. Please have a look at this one-shot view of SENSEX for 3 years. From this graph, we can trace cyclical fluctuations as well as booms and busts in stock market. If you keenly watch the graph, we can find two cycles of cyclical fluctuations. Cycle 1, January 2018 to October 2018. Cycle 2, October 2018 to July 2019. Similarly, we can trace the booms between July 2019 to January 2020. In fact, the boom seems to have set in during October 2018 itself. On the other hand, we can notice bust or recession during January April 2020. During boom, there is a steep rise and the market hits its peak, and this has happened during January 2020. During boom, the economy overextends itself and a correction in the form of recession becomes due. In reality, the post January 2020 recession is not a natural event of response but COVID 19 induced market instability. Since it is a COVID 19 induced market instability, let us now examine the prospects of market recovery in the near future. It is interesting to note that the big drops in the stock markets have been happening in our country once in every 5 to 10 years, and these markets have recovered as well. Please look at this table. These events such as Harshad Mehta 1992, the Asian crisis 1996, tech bubble 2000, and global financial meltdown 2008 have led to the plunges in the stock market. These plunges in the stock market ranged from 40% to 61%, and these plunges stayed for about 1 to 4 years. The interesting part is the market recovery. The period taken for market recovery ranged between 1 to 2.5 years. As on date, COVID 19 has caused about 30% crash in the market. We have now a couple of questions. Question number one: can we fall back on the revelations of plunge in the market and their corresponding recovery periods and recovery levels of these historic instances while assessing the prospects of stock market recovery under COVID 19 era? Question number two: what are the stumbling blocks in our assessment of prospects of market recovery? Now, let us ponder over these issues. Friends, let us not forget that the driver of the current downfall in the stock market is a virus leading to medical emergency and in turn economic hardships. Thus, it is unusual and therefore the insights of market revival in the preceding events could be of less utility in this context. There are two major stumbling blocks to market recovery in COVID 19. One, virus related issues. Two, the underlying economic issues. The issues relating to virus include it's newly discovered, spreads incredibly fast, pandemic in nature affecting as many as 206 countries so far, no one has immunity to it, and there is not much research on it, and hence neither vaccine nor medicine available for COVID 19 now. Secondly, there are economic hardships consequent on economy coming to grinding halt during lockdown. As we have already seen, there are huge cash outflows on the part of the government. As a result, India misses the fiscal deficit target. It also aggravates India's external account because there is a fear of foreign investments being withdrawn. In addition, at the global level, it is feared that there would be sharp economic contraction ranging from 10% to 20% in the global level. The global consumption and trade would remain crippled for a long time, which is tending to cause global recession. Because of the interdependence of international economies, the global recession will have its own say on the recovery process. The recovery of Indian economy in general and stock markets in particular would take more time than what the economy and markets took time to recover in the earlier events. Now, what is the way forward before India? That is a big question. Let us now try to seek answer for the same. The economic survey released a day before Finance Minister presented the Union Budget for 2021 on February 1 had projected a GDP growth of 6 to 6.5%. Because of COVID-19, these rates are going to be revised. We have already got the data in this regard. The projections given by various institutions and agencies range between 0 to 4%. Now, please look at these forecasted economic growth rates for India for 2021. In the first instance, Moody's, Nomura, and Fitch project India's growth rate to be 0%, 0.4%, and 0.6% respectively. Secondly, the IMF, World Bank, and ICRA view a moderate growth rate for India at 1.9%, 1.5% to 2.8%, and 2.8% respectively. Thirdly, there is still a brighter view of India's growth rate where CRISIL, S&P Global predict 3.5% each and ADB 4%. Please note that these are all preliminary forecasts based on information available as of now. Let us not forget that the COVID-19 onslaught is only at its early stage now, which is still evolving rapidly and showing no signs of abating. This phenomenon naturally calls for a serious thinking on adopting a multi-pronged strategy as the way forward. Let us see how this strategy has to work. Please see this chart on multi-pronged strategy, which focuses on two aspects. One, vigorous containment, and two, economic growth accelerators. Firstly, the vigorous containment strategy is as important as injecting $1 billion stimulus package into the economy. This strategy includes identifying, containing, and preventing hotspots, wearing masks and social distancing, carrying out rapid diagnostic tests, strengthening health systems, developing vaccine, and fostering attitudinal changes. Secondly, initiating a host of growth accelerators in the domestic and external front is required. In the domestic front, a lot of things are happening in the form of relief measures. RBI has offered support up to 3.2% of GDP. Similarly, the Government of India has extended help to the tune of 0.8% of GDP under Pradhan Mantri Kalyana Yojana and 10% of GDP under Self-Reliant India program. Under the Self-Reliant India initiatives, empowering the poor and laborers, migrants, and others from both organized and unorganized sectors is noteworthy. Honorable Prime Minister has strongly advocated for being vocal to street vendors, cottage industry, MSMEs, middle class, industries, and other segments, thereby creating a strong pitch for local manufacturing and local products. Further, it has been decided to open business with reduced strength and social distancing, and to allow delivery of non-essentials by e-com companies. On the external front, we have enough scope for translating COVID 19 led challenges into opportunities. For instance, it is time for us to attract companies that wish to move out of China. All along this, the time is ripe for changing FDI policy to protect Indian companies from opportunistic acquisitions, as well as making India an integral part of global supply chain. All these initiatives and reforms go a long way in making India a self-reliant, as well as creating a strong and healthy capital market. Friends, let us now move on to draw conclusions from our study. Now we are on the last leg of our presentation. Friends, we began this presentation with raising concern about the impact of COVID 19 on Indian economy in general and capital markets, thereunder stock markets in particular. The study carried out analysis and discussion on four specific aspects of impact of COVID-19 on stock markets. 1. Stock market movements. 2. Impact of COVID on capital markets. 3. Projection of stock market movements. And 4. Prospects of market recovery. In stock market movements, we examined the downfall in the stock market with reference to Bombay Stock Exchange SENSEX. We demarcated the analysis into two specific aspects, namely downfall during pre-lockdown period and downfall during lockdown period. In case of impact of COVID on capital markets, we discussed on wealth erosion and major losers both in sectors and players. This was also with reference to BSE SENSEX. We extended this discussion further and presented a theoretical model on impact of lockdown on corporate sector and capital markets. In case of projection of stock market movements, we used the data from Financial Forecast Center with reference to BSE SENSEX. In case of prospects of market recovery, we drew historical evidences of stock market recovery in India and presented on the limiting factors to market recovery process in the context of COVID-19. In addition, we had one more section on the way forward that contained a multi-pronged strategy in addressing COVID-19 scenario. In this background, let us have a quick look on the specific conclusions pertaining to the impact of COVID on stock markets. 1. There is a strong selling in the market. 2. The equity investors have lost their wealth and P/E ratio is less than 18. Historical rates being 20 to 24. 3. There is a need to rebuild public confidence in stock market. 4. Stimulus package would facilitate in building economy and in restoring investors' faith in stock markets. 5. Investors to utilize the bearish trend for building stakes. And sixth and the last, post elimination of COVID, the stock market picks up. Here I conclude my presentation. Friends, I thank you all for listening to my presentation. Please feel free to offer your comments and post queries. Here is my email ID. Thank you all so much. Thank you.